I want to go into further material in connection with money and banking. I want to start by backing up a bit under the heading, The Origin and Evolution of Money and the Contemporary Monetary System. We sort of started that in the middle with discussing how the monetary system has evolved since the Civil War, what it is that displaced the precious metals, put them out of circulation, how we got to the kind of monetary system that we have today. But I think we need also to have some understanding of how money as such developed. If you stop to think about it, everybody is very eager to get hold of these things. We'd all like to earn more of them.
You passing them out tonight?
Yeah, I'm distributing a large supply. I have a bushel basket outside. So why is it that everyone is so eager to get hold of this stuff? Because if you think about it, what can you actually do with this other than spend it? And the fact that you can spend it rests on the fact that everyone else wants to take it from you. They'd like to have it too. Well, why do they want it? So they can spend it. But why? Is this an infinite regress that everyone is taking it because everyone else will take it? Is that satisfying that something exists in effect because it exists and there's no explanation? I mean, are people behaving in a kind of crazy way in all being eager to take money? Because apart from spending the money, what can you do with it physically? Can you eat it?
You can burn it.
You could burn it. Does it make a particularly good fire? I wouldn't think so. You might also perhaps try to use it as wallpaper, but it's pretty ugly as wallpaper. So it really has no physical commodity uses. It's essentially useless other than the fact that everyone is very happy to accept it. But now we need to understand, why is everybody happy to accept it? And saying, well, because everybody else is happy to accept it, that really won't do. What allows money to exist is a series of developments. Nothing could begin as money that did not have other uses. Nothing can ever start off as money out of the sky, in effect. For example, there's a kind of money in the game Monopoly. But do you think that you could go and buy anything with Monopoly money? Why won't people be willing to accept Monopoly money in exchange for goods and services? Well, you could say because nobody else is taking it. Well, why don't people take Monopoly money? Why does everyone take the existing monies? Well, there's actually a rational explanation, and that is money always originates as something out of something which was not money, out of something which had ordinary physical type uses. Now, you could understand why are people willing to accept bread, at least sometimes, in exchange for things they're offering. Because you can eat it. And it's not difficult to understand why people want to eat bread. It helps them stay alive. It nourishes them. So that's perfectly intelligible. Or why they might want to accept something like wine or cloth or the means of producing such things. There you can see something that has physical uses that serve human needs or that are usable in the production of such things. So there is some intelligible tie to human life and well-being. Well, actually, money originates on the foundation of things that have physical uses. Money did not always exist. In the early days of human beings, and for probably many, many thousands or even tens of thousands of years, there was no money. There was occasional barter transactions. Members of some tribes might exchange some of the things they possessed with members of other tribes. A little bit of division of labor might have developed. There were exchanges going on here and there, but no money yet. The way money originated was out of a foundation of barter, the physical exchange of useful goods against useful goods. And then people saw very, very often that while they might want something another party possessed, that other party perhaps did not want what they possessed and had available for exchange. This is a problem we referred to, I guess, 2 weeks ago, the lack of a double coincidence of wants. In order to have a barter exchange, in order, for example, to exchange eggs for shoes, the party who has the eggs has to value the shoes above the eggs he's offering. The party who has the shoes simultaneously has to value the other's eggs above his shoes. You need two parties with opposite valuations, opposite comparative valuations of the two goods. So the owner of the eggs, in order to take shoes for them, would need to value the shoes above the eggs. The owner of the eggs would need to value the shoes above the eggs. I hope I didn't repeat it the same way. It should be reversed. Okay. Now, but again and again, the owner of one of the goods might find that the party whose good he desired didn't desire what he had. That would occur again and again. So imagine I have a raft, and what I want is a plow. You've got the plow, you don't want my raft. Well, what could I do? Well, I would be willing to, if I could find out what it was you did want. Maybe what you want is some urns, or maybe you want some armor, or whatever it might be. Something that I didn't have and didn't want, but I would be willing to exchange what I had for something that you did want. Because once I got what you did want, then I would have the means of offering you what you wanted, and I could get from you what I wanted. So if the owner of the plow is willing to take some urns or whatever, or a quantity of wine, even though I don't want the wine or the urns, I'll be glad to take them for my raft as the means of getting the plow from you. Now, when people start behaving in this way, exchanging what they have for things that they themselves don't want, but which others do want, to have the things they want, that is a process of indirect exchange. Instead of the direct exchange of one good for another, and it ends there, people are willing to exchange what they have for other goods in a process of indirect exchange, which they then re-exchange with the party who has what they want. Now, certain goods early on came to be selected as media of exchange, as goods more or less frequently used to effect further exchanges. And there's a kind of process of natural selection, what sorts of things would be singled out as more or less widely sought in order to be re-exchanged for the things people wanted. At different times, in different locations, in different historical eras, different things have served as media of exchange. In a society of nomads, well, practically every nomad would like additional cattle or sheep. So if there's something you would want to obtain from a nomad, cattle or sheep would be a reasonable medium of exchange. If there's anything they have, you're more likely to be able to get it from them voluntarily if you would offer them cattle or sheep, depending on what type of nomad they are. At other times, cow hides and sheep skins have served as media of exchange. Various metals have served as media of exchange, not just the precious metals, but iron, copper. Beads have served as a medium of exchange. The American Indians were using wampum in that same period. Tobacco sometimes served as a medium of exchange. There can be a wide variety of things that at one time or another served as media of exchange. Now, what would be suited as a medium of exchange is the kind of thing that was easier to re-exchange than what you started with. There are some things that relatively few people want or don't want very often. There are other things that more people want more often. And other things being equal, if you can exchange whatever it is you have for something that is more widely and more frequently desired as an ordinary commodity, your odds of getting what you do want are substantially increased. Now, to fast forward this to, say, 55 years ago or thereabouts, 60 years ago, in the aftermath of World War II, there were places where the normal conventional monies had broken down through hyperinflation. And in that environment, in some places, cigarettes emerged as a kind of quasi-money. And that was a perfectly reasonable development. And seeing why that happened sheds light on the process of the development of money. So imagine that you were living, let's say, in Germany perhaps, or any other country that had suffered major wartime devastation. They, of course, were the responsible parties for it. But suppose here you are, what you possess is some old typewriter. What you want to get is some kind of medication. Well, how many people do you think would possess the medication you're seeking and at the same time desire your old typewriter? I don't think that's very likely to happen. You'd be looking long and hard. But how many people do you think who might possess the medication, instead of taking your old typewriter from you, might be willing to take cigarettes, perhaps because they were smokers? That would be more reasonable. Now, at that time, the proportion of the population that smoked was probably substantially greater than it is today. So suppose you're in an environment, there's some substantial portion of the population that has a regular, recurring desire for cigarettes. Maybe it's 40% of the adult population, some substantial percentage. Well, if you can exchange whatever it is you have for cigarettes, your odds of finding what it is you want are much, much greater, because there's so many people who smoke and want to smoke the cigarettes you have. And so you'd be much more likely to be able to get the thing you wanted by first exchanging whatever you had for cigarettes. Now, notice what would give cigarettes this kind of role is the fact they're very widely desired. They have a reasonable period in which they keep their quality. You don't have to re-exchange them right away. You might be able to keep them for some weeks or even months and still be able to re-exchange them. So they would be a logical candidate to accept as a medium of exchange. Well, what happens as some significant number of people start to do this based on the fact that there is this large number of smokers with whom they can re-exchange the cigarettes, likely for what they want? Well, now what has happened to the number of people prepared to accept cigarettes in exchange for what they have? Pardon me? Well, I'm asking what's happened to the number of people who are prepared to accept cigarettes. It's increased. The initial core group is the smokers. But now there's a second group added on, the people who are taking cigarettes not because they want to smoke them, but because they hope to re-exchange them with the smokers. So we've now got a larger number of people prepared to take cigarettes than we had initially. This further number has been added on to the initial core group of smokers. So instead of there being perhaps 40% of the population willing to accept cigarettes in exchange, now there's a somewhat larger percentage. Maybe it's 45%. Well, how is this a greater preponderance of people willing to accept cigarettes? How will that affect the reasonableness of still other people being willing to accept cigarettes in exchange for what they have? They'll want it because now it's still easier to re-exchange cigarettes. You've got the initial core group plus that further group, and now we add on this still further group. Well, where does this end? If we have a situation, there's a growing number of takers based on a substantial initial core group. The more the takers, the more desirable the item is for use as a medium of exchange. Yes?
I was saying it would only work that provided you could limit the supply of cigarettes or the production of cigarettes, which you can.
Well,
Dilute the ones, or-
Well, that's another issue, but let's suppose there's nothing going on that will disrupt the usability of cigarettes. Let's suppose there's nothing that's going to working along those lines. Here we are now, we're up to 45 or 50% of the population is ready to take cigarettes. There's the core group of 40% perhaps, there's now a further 10%. What's the likelihood of yet more people being willing to take cigarettes, given there's this many more who take it from them? Okay, that will tend to increase, and where will this tend to go? How far would it go?
It will continue until you find another medium that would replace it.
Well, but how many, putting aside the development to get another medium, how many people could we expect ultimately? Everyone. Cigarettes would be tending to become established as money. The larger the proportion of the population willing to accept cigarettes, the more desirable they become as a means of further exchange, which tends to increase the number of takers. And the ultimate stopping point would be when everybody would take cigarettes. Now, at that point, if this went on for a time, people might think, yeah, well, we're all taking cigarettes because we all take cigarettes. But that isn't how it happened. It built up on the foundation of a core group that was taking cigarettes to smoke. And then there were enough of them to make it easy to re-exchange, and that's where it built up from. Now, in this process, it would be possible for further developments to occur that might seem surprising, but are fully understandable. First, you should already understand that non-smokers would be willing to accept cigarettes. Why would non-smokers be willing to accept cigarettes? For re-exchange. Not that they need to smoke them themselves, but there are enough people who do want to smoke them that they can exchange them with them. Now, someone mentioned, well, suppose the supply of cigarettes were sharply increased. Conceivably, that could stop their development as money. Maybe that's what did it. But let's imagine the supply of cigarettes could not be sharply increased. But now what's happening to the demand for cigarettes? We initially start out, the demand for cigarettes rests on the desire to smoke them. But now we're adding an additional demand, the demand for cigarettes as a medium of exchange. We've got two components of the demand for cigarettes, and that demand as a medium of exchange is getting larger. So what should we expect that to do to the exchange value of cigarettes?
Value of cigarettes.
It should increase it. And Mr. Rosendahl?
Yeah, I know this is a hypothetical situation, but I would imagine it applied somewhere in the past. You still have to obtain the cigarettes with something,
Yeah,
right?
yeah.
So there was still some other form of exchange, something else that had value to obtain the cigarettes to begin with.
Oh, sure. You're bartering, and I started the example off, suppose you have your old typewriter. That's an asset of some kind, and other people would have other things. The farmers are growing some crops, but you don't find that many people who want most goods. Something like cigarettes is widely desired, and other things, of course, have to exist to be exchanged against them or against each other. Yes, Ms. Yang?
Yeah, let's say that they do take tobacco as a medium exchange at that time.
Yeah.
Wouldn't everyone be making tobacco rather than producing?
Well, that could happen, and maybe that could interfere with the process. But what I want to ask you to do for a moment is imagine that as the demand for cigarettes goes up, suppose the supply could not be correspondingly increased. What would happen to the value of cigarettes? It would increase. So the value would become higher based on this additional demand for cigarettes as a medium of exchange. And if that couldn't be accompanied by a corresponding increase in supply, the value would go up. Now, the reason I want you to consider this for a moment is that to the degree that this would happen, how might it affect the behavior of smokers?
We would tend to stop smoking.
Yeah, they would tend to reduce their smoking because they'd literally be smoking money. So you get two developments. First, people become eager to take the thing who don't want to use it for any personal purpose. They just want to re-exchange it. And then the actual physical use may become very limited or conceivably could cease altogether because it's too valuable to use now for its original purpose. Yes, Mr. Weatherford.
We're sitting here talking about the value of cigarettes and what would happen if everybody could produce their own cigarettes. It isn't a fact that we just change the story right around to money here in America today. We are indeed, although none of us has a printing press, creating money by our work. That as we work, as we increase productivity, as we sell more goods, we're forcing the government to create more money.
Okay, Mr. Weatherford is saying, isn't it the case that everyone is, in some sense, creating money because they're all attempting to work and produce more, and this is somehow forcing the government to create money? Well, you see, where is the money being created? Is it being created in the work and production of the people or by the government? I suppose the government didn't create the money. Then the people aren't creating it. It's the government that's...
People would make something else that substitutes for money.
Well, you see, people are offering their labor services, they're offering products in the market, and if the quantity of money did not increase, what would be the effect of the offer of more goods and services on the prices of things? They would go down. So the people aren't creating money, the people are creating wealth and providing services, but in the absence of additional money, the prices would simply go down. What makes the prices go up, despite continuing substantial increases in production, is that the government is creating money more rapidly than the people are creating additional goods. Okay, but these points about cigarettes being taken by non-smokers and at the same time possibly becoming too valuable to smoke, these are not just abstract points. They have a real-world bearing in explaining the value of such a thing as gold. Just think, when gold was money, everybody was very eager to take gold as money. And yet, what are the physical commodity uses of gold?
Jewelry.
Okay, it's used for jewelry. To some extent, as utensils, but that's pretty rare, certainly nowadays. In dentistry, it's a very good conductor. Pardon me? Electronics. It's an excellent conductor of electricity. I think it has very good properties in connection with air deflecting heat. So there are physical uses, but the great bulk of the use would be as money, and the ordinary commodity uses would be very minimal. And it would be easy to think, looking at such a circumstance, that gold, from a physical point of view, is a relatively trivial type good without any serious uses. But in fact, as a metal, gold is capable of doing pretty much what any other metal can do, certainly if it's properly alloyed. Certainly whatever you could do with lead in terms of weight, I think gold in the same volume weighs even more than lead. And it does have these other properties that have been brought out. Why would gold not be very extensively used to serve the various physical purposes that it's capable of serving?
The lack of supply of gold?
It's very, very rare. It's rare. And when you couple that with people wanting to use it as a medium of exchange, well, what does that serve to do to the value of gold? It makes it very, very high and withdraws it from most of the potential physical uses that it has. It's like the cigarettes becoming too valuable to smoke. Gold is too valuable. You could have, instead of silverware, you could have goldware. instead of a chrome bumper, why not a gold bumper? It would be nicer looking. Most of us can't afford the use of gold in such ways. I think it's estimated that if you could concentrate all of the gold that's been mined since the dawn of history in one location, it might fit on a cube of 60 by 60 by 60. The mound of the infield, maybe today would take 2 such mounds. That's all the gold in the world. I think the total supply in the world is about 4 billion ounces. That's physically enough to make one good-sized ship. You could do it too, and a gold ship would probably float if you design it properly, but we can't use it for such purposes, even though it might be capable of them, because there's so little of it, the value has to be high enough to limit the amount that we're attempting to use to the very limited quantity available. Yes, Mr. Wright.
Provided then you can limit, based on the cigarette and gold analogies, provided you can limit the production or limit production of anything, for example, even paper money, if you can limit it that dollar bill that's printed, be only printed in such a certain quantity each year to increase each year or not increase at all. Money or paper money then would function exactly the same as gold.
If paper money were made as limited as gold, then it would function in the same way.
I mean, paper money wouldn't need a standard per se, other than a written standard saying you will not do or produce any more than this amount.
If paper money were as limited in the increase in its supply as gold is, then it would achieve a comparable value and stability of value as gold. It could not have become money on its own. It has to begin on a foundation of something prior, but if the supply were as limited, it could be as valuable. But there are major differences. You see, what compels the limitation of gold?
Physical factors.
It's physical factors. Gold is rare in nature. If you did a chemical analysis of what is the mass of the Earth made of, the percentage that's comprised of the element gold would be among the least. There's a good chunk of the Earth's mass that's made of iron, a significant amount that's made of nickel, a lot is carbon and nitrogen and whatever, but gold ranks far down on the list, and this means that we have to dig laboriously. We might have to move a ton of earth to find an ounce of gold. So this makes it very expensive. I'm sorry, Mr. Riches, yes.
I know diamonds are controlled by cartels,
Yeah.
the supply of diamonds. Is the same thing with gold? Are the cartels that are restricting the supply of it?
No, I don't think there is a gold cartel.
Okay.
Yeah. And it's much, much more difficult to try to restrict the supply of gold. It's more widely available. And I think the role of new diamonds is much more important than the role of new gold. See, there's a vast accumulated stock of gold, and the current annual production may be on the order of like 2% of the outstanding accumulated supply. So even if you could somehow reduce the current production somewhat, if you controlled 25% of the current production, you might achieve the annual increase being 1.5% instead of 2%. But how much would you be able to affect the value by restricting the overall supply that little? I don't think it could possibly even pay. Plus, gold is much more widely found. Diamonds are found in just a bare handful of locations, but gold in many others. And in fact, there are even trace amounts of gold in seawater. If you could run enough seawater through certain types of filters, you could accumulate sizable gold. But at present, that's very expensive to do. Yes, Mr. Whitesides.
Okay, I got a question about the world supply of gold,
Yeah.
or the United States supply of gold. You know, they always talk about Fort Knox, right?
Yeah.
Is that? Can you take a tour of Fort Knox? Can you see the actual supply of gold, like these gold bars, like that apparently exist?
I really don't know.
Oh, you don't know?
No.
And then, so you don't know if that's possible, or does anybody here know? Field trip?
There was some question raised some years ago, I forget how many years ago, is the gold really in Fort Knox, which may be what you're driving at, and apparently it is. There's a large part of the gold supply in the vaults of the Federal Reserve Bank of New York.
Because I know you can take a tour of the Federal Reserve. I don't know about the one in New York, but like you can take a tour and see these giant pallets of money, like in the basement.
All right. Well, I don't know about Fort Knox. I wouldn't be surprised if you could, but I imagine they have a website.
Okay.
You could look them
I'll
up.
get back to you on that.
Okay. All right. Now, a very important point that needs to be covered is what is it that brought about gold and silver becoming the money of virtually every civilized country. Even gold and silver were not always money. They were never. They were not the only things that have served as money. But there were good reasons for gold and silver becoming money and displacing previously established monies or quasi-monies. For example, in the early Roman Republic, they were using iron coins as money. Iron once served as money, but it was displaced by gold and silver coins. And I think the likely explanation is that iron became easier to produce. Some improvements were developed. So iron lost a good chunk of its value relative to other goods. Gold, being much, much rarer, retained its value. And the way you can imagine the process of gold displacing iron would be, suppose here we are, you want to accumulate a certain store of exchange value. You want to be able to have the ability to buy things in the future. Now, one way of doing it, if iron coins are money, is you build up an accumulation of iron coins. And then when you want to buy something, you have to go and exchange them with a seller. Or you could maintain the same value in exchange in a much, much smaller bulk if you sold your iron and bought gold. If you use your iron to buy gold, I should say, if iron is money, you don't sell it, you use it to buy things. If you bought gold and held the gold rather than a large quantity of iron coins, that's much easier to hold, and then when you want to use the accumulated store of value, at that point you sell the gold back for the prevailing iron coinage and buy what you wanted. See, gold, because it's so rare in nature, the rarity in nature assures the existence of a high commodity value of gold. Gold has to be more valuable than things like iron, copper, lead, zinc, silver, almost any other metal, because it is so much rarer. It has the same basic utility as the other metals, but is vastly rarer. And this combination assures that gold will have a much higher exchange value. Now, maybe I need to address the issue. If people want to hold a store of value, I'll get to you in a moment. If people want to hold a store of value, an ability to buy things in the future, and we don't have the kind of modern institutions that we have today. You have all kinds of financial instruments, insurance instruments, annuities, bonds, stocks. If we did not have such things, or if we judged that they were unreliable, how would you provide for your ability to buy things in the future? You'd want to have physical assets that you could use as a means of exchange later on. Well, now, what sorts of physical goods make sense to hold? Well, what they want. Now, everybody would like, most people would like milk, or there's certainly no shortage of people who like milk. But would it be a good idea to say, well, I'm saving up and providing for my old age by stockpiling milk? No, you don't want anything perishable. So that rules out all vegetable products, all processed animal products.
Commodities.
Pardon me?
Commodities?
You want, well, these are commodities too, what you want are durable, storable commodities. Animal and vegetable products are ruled out. Live animals, if you're no longer in a society of nomads, live animals are difficult and costly to maintain. They die. So their availability for the future is also limited. You get down to two basic classes of commodities, the metals and the stones. And now, why would you not want to hold base metals or bricks?
So many of them.
Too low a value and too high a bulk. Now, I've explained gold necessarily is more valuable than almost every other metal because of its rarity. And so if you're going to hold a metal and you want to have a store of buying power in a small bulk, relatively easy to move, gold is a very logical candidate. Now, you could say, well, don't similar considerations apply to precious stones? If you're going to hold stones, diamonds are incomparably preferable to bricks. You can have many thousands of dollars of buying power in a handful of diamonds. You need a huge warehouse to hold the same value in the form of bricks. But there's an important advantage that precious metals have over precious stones, and that is that the metals can be subdivided and then recombined. You cannot subdivide precious stones beyond a definite point. They need to be cut in a certain way to maximize their value, and once cut, they can't be recombined. Each stone differs significantly from the others. It requires special powers of appraisal, special skills of appraisal, but it's much easier to make judgments about the weight and the fineness of gold. There are relatively simple tests that can be performed. So these are important advantages of precious metals over precious stones, which make them more suitable as a store of value. Now you had a question. I'm sorry, Ms. Sagardaccia had a question.
I'm curious that when you're talking about gold and iron coins, were you saying that gold could be exchanged then at that time for more iron coins? So
Yeah.
I could give you one gold coin and you could give me, let's say, 20 irons. Which I'll get more for my money.
If we're doing it ounce by ounce, if an ounce of gold acquires the value of 100 pounds of iron,
Right.
well then your ounce of gold could buy a substantial quantity of iron coins. Now, yes, I'm sorry, Mr. Davis had a question
I was
first.
just curious, currently platinum is about twice as expensive
Yes,
as gold is.
yes,
At about $800 an ounce.
yeah.
What has been the historical value of platinum, and why wasn't platinum selected to be the standard?
All right, that's a very good question. I think maybe platinum came into use much later on and is significantly rarer than gold. Maybe it never had sufficient availability to be established. I'm not perfectly clear on why. I think probably its later introduction is perhaps the most important explanation. Yes, Mr. Sweeting.
The point about the metal versus the precious stone. So
Yeah.
the precious metal it's got an equal unit value, so no matter how large a mass you have, it's equal value across the unit, where like a precious stone, like a 2-carat diamond is worth more than 2 1-carat diamonds.
That certainly, that's often the case, yeah.
You could lose value there. Versus the 1 pound negative gold.
Yeah, you can't simply divide. Diamonds are not homogeneous, interchangeable goods. But every ounce of gold of the same fineness anywhere in the world is a perfect substitute for every other such ounce of the same fineness.
Oh, that's true.
And you can subdivide gold to very small quantities. You can't subdivide the diamond beyond a very limited point without destroying its value.
Lose value as you broke it down.
Yes, it would. Yes, Mr. Taylor.
Based upon the example you gave with iron coins as opposed to gold, and how some might, even though iron was most spent, some people might cash in let me give you all this iron, I'll hold the gold. When I'm ready to spend, I'll come and cash it back. Then today, for us, would there be any logical reason why we wouldn't want to go and purchase, our own gold holdings and put them in a safety deposit box and wait a while?
All right, that's a very good question. Mightn't the same kinds of considerations that applied many centuries ago when people began holding gold rather than the prevailing iron coinage, mightn't that have some application to our own time? And it actually does. You see, there are people who do have holdings of gold, and they've got gold in safety deposit boxes or wherever else they may have it. And why would people want to hold gold at all?
Future transactions.
Money value.
They believe that it will retain its real buying power better than the paper money.
Dollar bill going down.
Yeah. Now, you see,
Against inflation.
you've heard of the expression, I believe, inflation hedges.
Yeah.
Now, inflation hedges start to appear necessary when the conventional forms of investment come into question. Like if you're worried significantly about the prospects for inflation, would it be a good idea to have any kind of bonds or other fixed income assets or securities of any kind? Because what will happen if it becomes possible that in a single year prices could rise 10%, maybe 30 or 40%? Who knows where it could end? What is that doing to the buying power of anything stated in terms of a fixed number of dollars? It's wiping it out. So that jeopardizes the value of all bonds, notes, insurance policies, bank deposits, anything of that kind. And this is a serious concern. It has been for over 2 generations now. And this is one of the reasons that explains the height of interest rates over the last few generations. People are concerned, they think that prices are going to be rising in the years ahead, and if they were just getting ordinary conventional interest rates, their interest return would be wiped out simply by the rise in prices. If you're getting 3% on your money, and prices are rising 3%, well, how much more do you have in terms of buying power after you've collected your 3% interest than you had a year ago? You have no more buying power. Plus, you probably had to pay substantial taxes on the 3%, so you have less buying power. Now, what happens is, in those circumstances, interest rates tend to acquire an inflation premium. They tend to be higher in an effort to discount the loss of buying power due to higher prices. So instead of interest rates possibly being 3%, that people are anticipating 3% increases in prices, then the interest rates tend to be 6%. And within limits, that can provide protection. But it can happen that when the market discounts a 3% rise in prices and achieves interest rates of 6%, what happens if then prices start rising at 4 and 5%? Well, then maybe interest rates will have a 4 or 5% premium. But suppose that happens, and then prices are rising 7 or 8%. Well, there comes a point where people wake up to the idea that there is no interest rate that they can get in the paper money that will be high enough to protect them. And we were actually on the verge of that happening in 1979, early 1980. We had gone through a period in which prices were rising at an accelerating rate. First they had been rising 2%, 3%, then 4, 5, and by the end of the 70s, prices were starting to rise at double-digit rates. And many, many people, myself included, were prepared to believe that the United States was going to enter into an era of inflation comparable to that of the Latin American countries, with prices rising 20, 30, 40%, and so on. And as this belief became widespread, the long-term credit market virtually disappeared. We're used to 30-year fixed-rate mortgages. Well, as the rate of price increases accelerated, the interest rates on these mortgages went up too. My wife and I bought our house at the end of 1978, and we got a mortgage, which we were glad to get, at 9 7/8%. But a year or so later, you couldn't get a 30-year mortgage at all. The only kind of loans people could get were loans payable within 5 years in one lump sum at a 15% annual interest rate. Because lenders, by that time, they had been burned so many times, they saw that even though they're getting 7, 8, 9, 10% interest rates, the rise in prices is quickly wiping them out. So they were ready to stop lending. And all of the long-term securities markets were in turmoil. And for reasons to be explained late in the term, in conditions of rapid inflation, the stock market does not do very well either. The stock market may rise in dollar value. Everything is going up in dollar value. But for reasons to be explained, the rise in the stock market tends to lag the rise in commodity prices. So over a period in which the stock market might double, commodity prices perhaps go up 4 or 5 times, which means that if you're in stocks, your real buying power is still very substantially reduced. So even stocks turn out not to be such a good investment. Family businesses have similar problems. So in that kind of environment where all of the major conventional forms of investment are now unprofitable, in that environment people start thinking of inflation hedges, physical goods that they could own whose price will rise more or less in line with the general run of prices, and thus enable them to retain their buying power. Well, what are the candidates? Okay, it's certainly not perishable items. It's not animal or vegetable products. It's got to be minerals of some kind or another, and it's going to be precious metals and precious stones. And the precious metals have an advantage, as I've explained, over the precious stones. So in a period in which inflation is expected to be a major and accelerating problem, and there are no good alternative paper monies anywhere, here was the United States dollar, the money that everyone around the world had been counting on, and now it's appearing to go down the tubes. Well, then what's left, for most people, what's left is precious metals. And so the price of gold, as I think I may have mentioned, got as high as $850 an ounce in January of 1980. And then, to the surprise of many, many people, myself included, the Federal Reserve reversed course very strongly and reined in the rate of expansion of paper money and brought down very sharply the rate at which prices rose. So the inflation hedge demand for gold largely evaporated until maybe a year or two ago. And gold declined from $850 down to as low as about $240. So, Mr. Foster, I'll get to you and then.
I was just thinking to myself, when times get hard, don't black market items seem to increase in value, such as illegal drugs, liquor, and things that we're probably not supposed to talk about right now?
Well, when times get hard, more people may turn to alcohol and drugs, possibly. And so that might be a factor raising their value relative to the value of some other things. But I wouldn't think they would be a particularly good inflation hedge.
I was thinking back to the 20s with the prohibition and the alcohol that was stored and so on and so forth, and how valuable that was.
Well, someone once asked me why not use whiskey as an inflation hedge. For some people, that might be a reasonable thing to do. If you were a whiskey wholesaler and you have a warehouse, maybe it's a good idea to keep some of the supply back. But if you're just an ordinary person, maybe the best you could do in a modest way, if you collect wine, maybe you increase, you get an extra wine rack or something. But I don't think this is a very feasible method for most people. Precious metals would be the way to go far more often. and then given the limitation of supply, so you just think the inflation hedge demand for the precious metals is an additional demand. There's the regular ongoing demand, and then there's this further inflation hedge demand. That's what raised the price. And then as the inflation hedge demand evaporated because the degree of inflation fell, well, then the price of gold came down. You had a question, Ms. Foley?
I was just going to say, people saving gold,
Yeah.
all its different forms. I mean, there's safety boxes or security boxes.
Yeah.
I mean, it has to be in a certain form for it to be valuable. So,
Yeah.
I mean, you were saying they would stockpile it as an inflation hedge, but
Yeah. In what form would they do it?
I mean,
Yeah. Well,
does that matter?
pardon me?
Does that matter?
Within limits, it does. I mean, the basic forms are bullion bars and bullion coins. And the standard size bar is a kilogram, 32 troy ounces. And there are coins. The most common size coin is approximately an ounce. There are different gold coins. There's the South African Kruger rand that for a long time was extremely popular. There's a Canadian maple leaf. There's a Chinese panda. There's now a reissued United States double eagle. There's a Mexican 50 peso piece, which has 1.2 ounces. And so, and then there are smaller size gold coins. There are 1 pound British gold coins called sovereigns that are approximately a quarter of an ounce each. They were very popular at one time. Yes, Mr. Woody.
Okay, so these people you talk about who are, thinking that tough times are going to come and they're going to stockpile these precious metals, let's
Yeah.
say, in a safety deposit box or whatever.
Yeah.
Say at this point in time, the value of what it is now, say, doubles.
Yeah.
But at that point in time, times are, money is what I'm trying to say is like inflation is high and money's hard to come by anyway. How easily would it be for people to sell, at a top dollar, the metals that they have to others who don't have them? I mean, how easily would it be to exchange for?
Okay,
exactly.
pardon me?
Liquidate.
And what are the problems of liquidating
Especially
holdings of gold?
if they're waiting to a certain point to get, as high
Okay.
as possible.
All right, and I think it's the exact same sorts of considerations that were present when gold became money to begin with. You see, I got started developing how gold displaced iron coinage. Well, people are using iron, that's the prevailing money, but then there are people who decide gold is the most convenient thing to hold as a store of value. You can hold much more buying power in a few ounces of gold than in a few tons of iron. So they're holding gold. Now, at first, there aren't all that many of them. But suppose you have a situation, let's say 20 or 25% of the population of a country has decided that some part of their assets should consist of a gold holding. This is a significant percentage. By no means everybody, not even a majority, but some substantial percentage. Now, for a long time, when the members of this group want to buy something, they have to go and sell the gold for whatever the money is, whether it's iron coins or paper dollars. But as there come to be more such people, what happens when someone who has gold and who wants to obtain money to buy something from someone else, suppose the seller would also like to hold gold. Then the possibility opens up of a direct exchange of gold for goods, because there's now enough people so that there are on the one side people holding the gold, there are others who'd like to acquire gold, and they can skip the stage of selling the gold for iron coins, then using the iron coins to buy the goods, or conceivably skip the use of paper money in between. I suppose you had a holding of gold and you wanted to buy some significant sized asset, and the seller is not all that keen on paper money or anything payable in paper money, and he's looking to the long-term value of gold. Well, in that environment, it's possible for gold to purchase the asset. And then there's another element that kicks in, working in the same direction. When people get the idea that the future value of gold is more assured than most other things. So you just think, if you entered into a contract calling for payment in bushels of wheat, and your payment was going to come due in some year, well, what sorts of factors can radically affect how much that number of bushels of wheat is worth in terms of other things? The supply in that year. The price of wheat has huge variation from one year to the next based on changes in supply. Now, there's a good reason why the variation in gold would tend to be a lot less, because the accumulated stock is so much more important compared to the current annual production. So if the current annual production of gold should be up or down a couple of percent, or 10% or 20% even, when you compare that to the overall total accumulated stock, it's relatively small. The variation in gold from year to year would tend to be a lot less. So this is a factor encouraging the making of contracts in gold rather than other commodities. Now, also, very closely related, if you feared the future of paper money, if you thought, well, paper money is just going to be less and less valuable, what kind of contract would you like to write? How do you think contracts are written today in Mexico and South America?
Dollars.
In dollars, because they're considered much more stable than the local currencies. But if the dollar itself came into serious question, then people would be interested in writing contracts in gold.
Or euros.
Or maybe euros, that would be a contender, or maybe yen, that's a possible contender also. But now notice, if, and to whatever extent, contracts come to be payable in a particular money, what position does that put the people who have contractual obligations? Let's say here we are, I've entered into a contract, I'm going to pay you over so many years. Let's say I'm a Mexican businessman, but I've entered into a contract requiring that I pay dollars over the next 5 or 10 years. I have to come up with the dollars one way or another. How will that affect my willingness to sell my goods for dollars if I can find customers ready to pay dollars? I'll be very happy to sell for the dollars that I owe. Now suppose what I owed came to be gold. How would that affect my willingness to sell for gold? Then I'd be very happy to sell for gold. So there are two developments that can go on side by side. On the one side, there are more people who own holdings of gold and who want to acquire gold. And to the extent that such people cross each other, you begin to have gold exchanging against goods. And then, to the extent that contracts came to be written in gold, there are more people who need to sell for gold also. So what's happening to the extent to which gold is becoming usable as a means of making purchases? It's increasing, and suppose we reach the time where some significant percentage of the population, not everybody, but some significant percentage, were willing to take gold. And you can use the same principle if you're in Ecuador, if a certain percentage becomes willing to take dollars. Well, what does that do to the willingness of other people to take the dollars or the gold? It tends to be a self-reinforcing process. And if we had a situation in which, over a period of years, and every year, the paper money were sharply losing its value, and at the same time, there are people turning from the paper to the gold, what would be happening to the rise in the price of gold compared to the rise in most prices? Gold would be rising compared to most prices. And what would that be doing to the buying power of an ounce of gold? It would be increasing. Just think in terms of that example I gave you last week of a $20 gold coin versus a $20 bill. If we had more rapid inflation, let's say over a period of years, prices in terms of the paper doubled, and in that same period, the price of gold tripled. Well, what would that do to prices expressed in terms of a given gold coin? Those prices would fall. If prices doubled, let's say if our fancy dinner went from $400 to $800, at $400, it costs $20 in gold, if gold is 400 an ounce. But suppose the price of that dinner goes to $800, and the price of gold goes to $1,200. Now how much does the dinner cost in terms of the gold coin? Less, only 13 1/3 dollars, I think. 2/3 of $20. So here you are, you're saying, my God, the price of this dinner, I was in here a few years ago, it only cost $400, now it's $800, but if you could pay in the gold, well, that price has fallen. So in the face of developments like that, what do you think people would be preferring to have their contracts written in? Gold. And as you had, the potential is there for a bigger turning away from paper or whatever the money is to the better money. And on that basis, the potential is there. Someday, if inflation becomes a more serious problem, the potential is there for a spontaneous remonetization of gold from the market. And that same principle is operative in different countries around the world where there are tendencies toward the abandonment of the local money in favor of the dollar. It doesn't happen instantaneously overnight. It's a process. A minority starts holding some different medium, and then it becomes possible to exchange with them. It's still easier to take that new medium, and it tends to go to the point of becoming money. Yes, Mr. Chung?
Actually, this question has two parts. The first part is that do you see or do you agree that there is a disparity between the trading value of money, paper money versus gold? And if you do, is that the reason why that, or do you believe that's the reason why that the U.S. government suppress the production of gold so that the dollar value would rise over time?
All right, you say you have two questions, and one question concerns...
Two parts.
Yeah.
The first question is that do you see a disparity between the trading value of paper money versus gold?
A disparity between the trading value of paper money and gold. Well, the only disparity I could understand is that gold tends to retain its buying power much, much better than paper money does. And the basic reason is that gold can only be produced in additional quantity at great cost and with considerable difficulty. It's rare in nature. Paper money has virtually no cost and can be increased in quantity without any fixed limit. So I would say on that basis, paper almost inevitably tends to lose its value compared to gold.
Well, along the same lines, that if that is the case, then back in 1995 or 94 to 96, between that time frame, the government, the U.S. government actually stopped, or London in England, okay, they stopped production of precious metals such as gold and silver. Okay, so that in fact that the factory in South Africa, the gold mine in South Africa, that they stopped production for over weeks and weeks, and therefore that over time we saw in the commodity market that the gold prices were at $580 some dollars, $600, and then gradually over time, over a year or so, it dropped down to 300 and so forth.
I don't remember this happening. You're saying that the United States government halted the production of gold in South Africa?
In South Africa, yes.
This is the first I've heard of it. Maybe the production could be halted. Maybe there was a strike at the mine or something.
There was a strike, and also that they talk about shutting down, and that's related to the question that I asked last week. Is that I read on the paper and also all other publication and so forth. They were indicating that there was a lot of gold reserved in the United States and elsewhere, around the world. And so as a result of that, they want to halt production of gold because that they foresee that gold become maybe suppressing the paper money, because more people, because back in that time, a lot of third world country was contract not through paper money, but through gold. And so maybe that's the reason why that, a lot of country were buying gold instead of dollars or keeping dollars and so forth. So
I don't think that the way you're describing things would explain what's happened, or I'm not aware of many of the things you're referring to. Even if the production of gold were halted for a limited time, which I don't think it was, unless there were strikes unconnected with one another, I don't think that would have a very material effect on the value of gold. The governments, until very recently, were intent on reducing the value of gold. Various central banks were unloading their accumulated gold reserves. For example, the Central Bank of Australia, I think now has virtually no gold reserve. They sold it off. They thought, well, what do we need it for? It's not earning any interest. We'll get a good price for it. They sold it off. Other central banks did the same. Even the Central Bank of Switzerland. And then in 1999, the Bank of England announced that it was selling part of its gold reserve. The only major countries retaining their gold reserves were the United States and Germany, and I'm not sure about France, probably France. But many of the smaller countries were actually unloading their gold, and gold got down a few years ago as low as $260 an ounce, maybe even $240, and there was fear that the price could go even further below that. Because just imagine, here's the United States. It has an accumulated stock of 257 million ounces of gold, on the order of 1/8 of the world's total accumulated supply. Suppose it just started dumping the gold. And now this gold, if people were not worried about inflation, and in the late 90s, I don't think there was very much worry. They thought the budget deficits are eliminated. We have surpluses. You could even read newspaper stories. They're looking forward to the elimination of the national debt by 2013. I don't know if any of you remember those stories. So in that environment, people wouldn't have much concern with the problem of inflation. And if you're going to dump all of the accumulated gold, or much of it acquired over the history of the world, where would that gold have to be used? What kind of uses would it need to open up to absorb that much gold? You'd have to have a much more extensive industrial employment. And in order to find such an expanded industrial employment, you'd need a very sharply lower price of gold. The price of gold then might have been below what it would have been had it never been money. See, had it never been money, we wouldn't have accumulated a massive accumulated stock. But having done that, if that massive accumulated stock had to be absorbed in ordinary commodity uses, it would take an extremely low value. So I think that was the threat. And then what many governments agreed to was not to continue liquidating major amounts of gold. They agreed to retain the greater part of their gold reserves, and at least for a few years. And then when they agreed to that, that halted the decline in gold. I don't think it was an issue of stopping the production of gold. No one would be producing gold at such low values. Yes, Mr. Richards.
I know I've read that in World War II the Nazis had vast amounts of gold. What happened to that gold after the end of the Second World War? Was that distributed amongst the Allies?
I don't know how much gold the Nazis had. You can be sure they had some, but I would think most of it they would have lost in purchasing materials, war materials, from places like Switzerland and Sweden. And much of that gold, in turn, would have come from those countries to the United States.
Japan as well, right? Did they? trade with Japan?
I don't think they could have very much trade because the sea routes between Germany and Japan were controlled by the American and British navies. But in World War II, the United States ended up with most of the gold of Western Europe and other areas of the world. So we had enormous gold reserves out of World War II. Yes, Ms. Glover.
Two questions. One, if gold holds value and it's basically, I think it's worth more than $1, then shouldn't everybody own some?
Isn't it a good idea for everyone to own at least some gold? Yeah, a modest percentage, maybe a few percent of your assets. No matter what would happen, you're not going to be wiped out. If you have like 5% of your assets in gold, well, if the value of gold plunges in half, you've lost 2.5% of your assets. On the other hand, it might have an appreciable rise. So it wouldn't be a bad idea.
And who would it behoove if we did have the gold and the dollar went way up? Who's going to want our gold? I mean, everybody else will want my gold, but do other countries, would they be interested in it? Only because, of course, it increases demand.
People are interested in owning gold all around the world. The first part of the world market that revived in recent years, I think, was in Japan. The Japanese citizens are among substantial holders of gold. Gold has some significant popularity in France and Germany, throughout Europe. They've had historically very, very bad experiences, which are passed down from generation to generation. In the French Revolution, they had a paper currency called the assignats, which became totally worthless. And that thereafter made France, many French citizens, ardent supporters of gold. Because the paper money, the assignats, became worthless, but the gold retained and even increased its value. In Germany, in 1923, and also in Hungary, they had a hyperinflation that wiped out the paper money altogether. And so that's now probably the generation of today's Germans' great-grandparents or so. But Germany is more nervous about inflation, or at least has been, than most other countries, because they had such major experience of it. And so you can be sure there's a good number of Germans who want to have some gold too. Yes, Ms. Nikolova.
Yeah, we had the same experiences when communism went down. Money was not worth anything. So, for example, my grandparents saved money for us, for the kids, in the banks. And overnight it was worth nothing. So all their life they saved money. They saved $10,000, for example, and then the next day it's worth $100.
Wow.
So anything that we had in gold, that was valued. So usually grandparents would make jewelry for the girls and all kinds of jewelry to save because we had such a traumatic experiences.
Yeah, well, that's a very helpful experience on what we're discussing. Yes, Mr. Castillo.
So you mentioned a couple of countries that really don't have any more gold reserves, and they're listening to her situation here. It would seem that really the only need for gold or any worry countries like Australia would have, because obviously they don't have these gold reserves, is if maybe their government had failed or would fail. In reality, that's probably the only reason that you would really need some type of reserve, because obviously their money is now it's a promise. It's, hey, you know, we're promising to guarantee this, but they don't have any gold or anything in value to
But it rests on the comparative limitation of supply of Australian dollars. Now, the fact that the Australian Central Bank may not hold any gold, or hardly any, that doesn't mean that there aren't individual private citizens in Australia who don't hold gold.
But the government issues their monetary, their money.
Yeah, the government issues the money. And if people, to the extent that people aren't happy with the prospects, then either they need US dollars rather than Australian dollars, or euros, or gold. Now, See, just think, and I don't want to belabor this because there's an awful lot more material to go into. If there were a move, if people did decide in large numbers, the value of paper keeps going down, the value of gold is stable or growing, and they did want their pensions payable in gold, all their long-term contracts, what would have to be done in order to keep paper money in circulation, to stop people from turning away from it and abandoning it in favor of gold? Well, raise the value of what?
Or lower price. Stop making it.
Stop creating it if the government declared that it would redeem the paper in gold at a definite price, and it had enough gold to make that realistic, and it would not issue more paper except as it had more gold, then they could keep the paper money in existence. See, they would be forced onto a gold standard. Otherwise, the demand for the paper would evaporate. Now, just let me point out, to wrap this up, gold and silver became established as money everywhere that fixed habitations developed, everywhere that people got beyond the age of nomadism and had fixed settlements. When you have fixed settlements, you can no longer have sheep or cattle as money. And gold and silver were the money of the world down to very, very recent times. In China, they had a paper money redeemable in silver centuries ago. Marco Polo tells about it in the story of his travels, which I think took place perhaps in the 13th century, if I'm not mistaken. So they had paper money long before Europe. Paper money started coming into existence in Europe on a very small scale, perhaps in the 15th century or thereabouts. But gold and silver continue to be the main monies. And the way that paper came into existence, first you had established precious metals. And then for safekeeping purposes, people began to leave quantities of gold and silver coin and bullion for safekeeping with gold and silver smiths. The gold and silver smiths could have strong safes that were well protected. And as the smiths began to issue receipts for the gold and silver entrusted to them, these receipts emerged as the earliest paper money in the Western world. If the receipts were in specific amounts, like suppose you deposited 10 gold coins known as guineas in England, you might receive 10 receipts, each for one golden guinea. Or you could receive a receipt in a different form, entitling you to give an order to the smith to whom to pay these golden guineas, or whatever the coin may have been, giving you the right to say, okay, Smith, I'm ordering you to pay to Jack Jones 3 of my golden guineas. Now, the first, where you have specific receipts, that's the obvious ancestor of paper currency. Where you have the right to specify the transfer of specific sums, that's the father of the checking deposit. And it was a very long, slow process in which paper money in note form or checking deposit form gained a foothold. But notice, the only way it could be introduced was on the foundation of a pre-existing precious metal money. You could not establish paper money independently any more than you get monopoly money to circulate. And then we explained how the paper ended up displacing the gold in the United States through the National Bank Act and other such measures, and similar measures elsewhere. Ms. Herrera?
In your
No, I had Ms. Herrera first. She had her hand up first.
Oh, I'm sorry.
I'll get back to you next. Yes.
My question to you was, earlier in one of the previous classes, you had mentioned that paying with actual gold was illegal, or was not allowed. Right?
At one time, from 1935 down to about 1975.
Okay, so now, like you were saying earlier, that if they were to change payment, they would pay with gold versus with actual paper money, that contracts would be paid with gold, then it would be okay to use the gold to pay? I mean,
Well, there's still one major aspect in which it's still illegal. The merchants are not allowed to discriminate between monetary units of the same face value. So if there's a $20 bill and a $20 gold coin, you could spend the $20 gold coin, but for no more than the $20 paper dollar, $20 bill, which means you'd be asked to spend something with a real value of $400 as though it's $20. So that's still the case. And then we don't have any significant gold contracts at present because it has not been made clear how such contracts would be treated. You see, suppose I lent you 100 ounces of gold, and when I lent it to you, gold was $400 an ounce. And the contract calls for your repaying me 105 ounces of gold. But when the time comes that you have to repay me the 105 ounces of gold, suppose at that time the price of gold has doubled. Now, it's very, very easy for the courts to decide that I am charging you a usurious interest rate. I've lent you $100,000, and I'm asking not for a 5% return, but for more than 100% return, because your repayment of the 100 ounces or 105 ounces of gold will be at $800 an ounce. That will be much, much more. So if it's not clear that the courts would recognize the enforceability of such contracts, that stands in the way of their being made. Then there's another very important problem. What would be the tax treatment of these contracts? It's one thing if I have an income of how do I declare my income? Is my income the monetary value of the 5 ounces of gold interest, or is it the appreciation on the principal of 100 ounces as well? So before we could have significant gold contracts, we'd have to clarify these matters. If we said that only the gold interest would be taxable, not the appreciation in the price of gold itself, and if we said that these contracts would be enforceable in the courts, then they'd come into being. Yes, Ms. Nikolova.
Really fast, gold comes in 3 different carats, right? So which carat is used for trading purposes?
Gold comes in a variety of carats. The carats refer to the purity.
Right.
I believe 20, is there such a thing as 27 karat gold?
24.
24 is generally the highest you'll find around. I don't know what precise percentage that is. If that might be 90% pure, I'm not sure.
9999.
Pardon me?
9999.
Is 24 karat?
Yes.
It is? Okay, well, thank you. Well, then that's about the purest you can get, 24 karat. Now, you could easily find out what was the purity of the gold coins. Probably on the order of 20, pardon me?
It's 18.
Just 18 carats?
Yeah, I went to London Traders last week after class.
Oh, yeah?
Like not after class, but day after. I got a pamphlet on it, and I asked him because the alloy has to be hard enough because otherwise it would bend. And so that's why it's like it's not as pure as the gold bullion. But the gold bullion reissued double eagles are 24 because they're not in circulation. So they have to put in like other alloys because of the circulation, so they're hard enough. Just like your rings are 18, they have to be hard enough or else they'll like fall off your finger.
18 is 775.
Right.
Okay, all right. Well, thank you very much for the input. Yes?
I know we're jumping around a bit, and
Yeah.
we were just about finishing up on number 3, how paper, including checkbook, money came into being.
Yeah.
In reading your capitalism, page 504,
Yeah.
you're discussing how checkbook paper came to be with the U.S. Treasury, and how they were running short of money. They called the banker. You give an example of how they were crediting the treasurer's checking account.
Yeah.
You talk about that. Is that what we're addressing here on page 504, is how paper, including checkbook money, came into being? Because you're also talking about precious metals being a foundation.
Okay, I think there's two senses in which we're talking about how paper money comes into being.
Yeah.
One is how it is currently issued, how the supply is increased today, and how it became established as money at an earlier point in time.
Okay.
Okay, so
Is 504 addressing current, or is it addressing?
it's addressing the increase in the quantity of paper money, how it comes into existence. You see, we've had paper money for a few generations, but this is just addressing how the supply is increased nowadays.
Oh, okay.
And what we were talking about under point 3 is how the phenomenon of paper money came about.
Okay. And so that's the example you're giving about how the gold and silversmiths were holding the gold.
Yeah.
It kind of leads to deposits and the
And notes.
receipt being the currency.
Yeah, and then gradually, see, for a long time, people who got receipts or notes, when they wanted to buy something, they might have to go back to the smith and say, give me my gold or silver, and then they'd spend the gold or silver. But when the clientele of the smiths became larger, then what could start to happen? Suppose there are a lot of people depositing their gold and silver with such smiths. Well, then what possibility becomes present? Yeah, you can trade the receipts for the goods, because if here I am, I have notes on a given smith, and if you got gold from me, you'd like to take the gold to that smith, why not take the notes? And it's much simpler. So to that extent, you developed an ability for paper money to actually exchange. You're Mr. Winchell?
Yes.
Okay. All right, now we have to move on to further material.
I have a good website for people that have more questions about gold, though. It's gold.org.
Gold.org. Okay.
If they have other questions.
Okay. Thank you for pointing that out. All right. I have a reference here, recent change in the composition of the money supply, the deficiency of the weekly reported M1 statistics. I think we dealt with that to some extent last week. Let me just bring that up. Here, I have a table over the years from 1985 down to the present, showing the money supply stated in different ways and calculating the change. The total current money supply can be estimated in different ways. Every week, a figure is reported on Fridays. It'll show up on Fridays in the newspapers of the M1 money supply. I call that M1 traditional, and that represents the sum of currency in circulation outside the banking system, the totality of all of this stuff and the subsidiary coin that's out there in circulation outside the banking system that has been issued by the Federal Reserve minus any paper currency that's come back and been destroyed. It's the totality of all the currency and the sum of checking deposits at in conventional form. All the checking deposits at commercial banks, at other banking type institutions, and that grand total as of the end of August was $1,337 billion. And then I pointed out there's an additional 600 plus billion that should be counted along with that, that doesn't appear because of this practice of moving money from conventional checking accounts into other types of accounts against which reserves don't have to be held. So when we add those two together, the current outstanding money supply is $1,956.9 billion. And then it's possible to add yet another component, possibly even more than one, and this is money market mutual funds, retail. Now what is this? Well, there are many institutions, notably stock brokerages, at which individuals can hold a checking account. Typically, they're holding a checking balance with a broker to have funds readily available to buy stocks. But over the years, increasingly, these checking deposits, or these deposits, have become usable to make all kinds of purchases. When they began, you were limited to writing perhaps 3 checks a month, and for an amount no less than $500. But increasingly, these deposits have become of a kind that allow you to write more checks and for smaller amounts. I have a small web-based business, and every so often I get a check drawn on an account at someplace like Merrill Lynch, and for much smaller sums than $500. So increasingly, these deposits have come to resemble conventional checking deposits. And if we count them, the current money supply would be $2,694 billion. It could be argued that it's even larger than that. So it's not very clear at the moment precisely what the money supply is. Now, there was a question back here from Mr. Rosendahl.
Yeah, I was curious about the M1 figure. I think you answered part of my question, which is this is the currency that the Federal Reserve knows of, right?
It's currency and checking deposits.
Okay. And is there a tally of how much at any one point in time counterfeit money is out there?
Okay. I don't think they count counterfeit money in the statistics. Okay. Now, but let me say what the outstanding currency is, the legitimate currency. The most recent figure I have on that is about 685 billion of paper currency and subsidiary coin, and a substantial part of that is held outside the country. Now, I don't know how much counterfeit money is out there. I'm unaware of any estimates. Maybe you have an idea.
No.
His principal.
Just curious.
Yes, Ms. Foley.
When you say it's currency outside the regular banking system, what do you mean by that?
Okay, well, the banks hold stocks of currency that counts as part of their reserves. That's called vault cash. That is counted when we count the reserves of the banks. It's not viewed as part of the publicly circulating money supply. The currency that is counted is the currency out there in the hands of business firms and individuals at home and abroad. Mr. Chung.
Do you know today is gold is the form of commodity that back up the U.S. dollar, or what else?
Is gold a commodity that's backing the U.S. dollar? No, the Federal Reserve holds a substantial quantity of gold. In fact, I believe it's just about 257 million ounces. But it doesn't represent backing of any kind. I mean, they could conceivably sell gold to keep its price down if they wanted to. But there are no longer any gold reserve requirements. The Federal Reserve is not legally obligated to have any definite amount of gold. Until 1965, it was required by law that the Federal Reserve have in gold, defined as $35 equals 1 ounce of gold, have in its possession gold dollars in an amount equal to between 25 and 35% of the paper currency and checking deposits held with it.
So with the $2,694 billion, I mean, those are paper money and
there's very little gold. If you multiply $400 times 257 million, that doesn't come up to very much of this. And in fact, the Federal Reserve carries the gold that it possesses on its balance sheet. It calculates it at a little over $42 an ounce. That's the last official price of gold. Gold was $35 an ounce from 1935 to 1968, I think, and then it was devalued to $38.50 around 1970 or so, and then about a year and a half later, it was further devalued to $42. Obviously, the dollar has been further devalued against gold to the neighborhood of $400. Mr. Castillo.
Really quick, back to money and the M1. You talked about M1 minus dollars destroyed plus a couple of other factors. Do you know, or maybe have a clue, or is it published on what percent really is actually in some type of circulation across the world and not hoarded? In other words, I think of CNN, I think of Saddam Hussein having these truckloads of money that were just stored, not necessarily ever in circulation.
Yeah.
And I'm sure there are other countries as well.
So you're asking, so what portion of the currency out there is
truly in circulation?
Is held off in safety deposit boxes and the like. I imagine there are people who've tried to estimate that. I would assume most of the currency held outside the U.S. would be in that position. And then I don't know how one would go about it. I'm sure there are significant holdings of currency in safety deposit boxes here in the U.S., but I couldn't tell you just how much. You might do a search on the internet to see if you could find a study. So I don't know what the answer to that would be. Yes?
Oh, these numbers that are all up here, these are all considered M1, correct?
No, not all. The first column alone is M1.
Okay.
Then I have this heading M1 plus, which is the sum of M1 plus the sweep accounts. So M1 plus would currently be 1956.9.
Well, we're not into like M2 yet.
No, now I have to say that I don't consider, see M2, let me explain what M2 is. M2 is the totality of M1, everything that's in M1, conventional M1, plus passbook savings accounts, plus small denomination certificates of deposit. That's considered certificates of deposit below $100,000.
Oh.
And then there may be a few other items, relatively small. You can get a precise definition of what's in M1 and M2 in the Federal Reserve Bulletin, or if you go into the website of the Federal Reserve. M2 also includes the sweeps, because they're a form of savings account, but they're only nominally a savings account. They're really a disguised checking account. They're just swept in on the weekend for reserve purposes. When something is a genuine savings account, I think it's of a different character. It's not actual spendable money. See, if you have money in any kind of savings account or a CD, can you spend your deposit as such? I suppose you had a passbook savings account, and it shows Joe Smith on deposit $5,000. Can you go in anywhere and say, hey, here's my $5,000 in the bank. I'm going to subtract $500 for your benefit. I don't think you can do that. But now, if you have $5,000 in a checking account, you can spend that checking deposit. You spend it by writing a check. You're spending part of your deposit. Savings deposits lack the attribute of direct transferability. Before you can spend them or spend the proceeds of a CD, you have to go and withdraw the money or liquidate the CD. You can't spend it in its existing form. So I think that's very different than M1. It's not part of the actual spendable money supply. So what I would consider to be the spendable money supply is the hand-to-hand currency and the funds that can be transferred by check, including electronic transfer, of course. And the best I can measure it now is not quite 2,700 billion.
The money market funds too?
Again, money market mutual funds, retail, and it's difficult to count them, especially over the years, because it's unclear to what extent they really are full-body checking deposits. See, if it's the case, and whenever it was the case, that you could only write 3 checks a month, and the minimum size check had to be $500, well, that enormously limits the usability of such a deposit. So it certainly would not be on a par, dollar for dollar, with conventional checking deposits. As these restrictions have worn away, these money market mutual fund deposits have become more and more like conventional checking deposits, but I can't tell you what the exact degree of substitutability is. Okay, so hopefully you have some idea of the current money supply, and the current GDP, the last time I looked, I believe is running at a little under $12 trillion. So you could relate GDP of roughly 12 trillion to an M1++ money supply of not quite 2.7 trillion. And that will give you an idea of velocity. Why did I do that?
2.7 trillion
M1++. See, M1++ is conventional M1 plus money market mutual funds plus sweeps. Now, I think this will bring up a spreadsheet which we looked at last week. Okay, here we are. We have, I hope you guys in the back can see this. Currently, GDP is about 11.7 trillion. The money supply, as I've just explained it, is about 2.7 trillion, which means the average unit of the money supply is being spent on the order of 4.3 times a year. Now this allows for that part of the money supply which is locked away in safety deposit boxes, which might be spent once in 10 years, and other money which is being spent and respent every other day. On an average, the turnover in a year is 4.3 times the 2.7 trillion, and that equals current GDP of 11.7 trillion. Yes, Mr.
Okay, so if I just want to make sure I got this concept correct.
Yeah.
So we have $2.70, right? Just to simplify this.
Yeah.
I spend my $2.70 4.3 times a year, and then I, so there's $11.70 out there in the economy.
Being spent, yeah.
Okay.
You've generated 11.7 of spending.
So my $2.70 goes through 4 different people.
You could look at it that way. You start out, you have $2.70. You spend it in buying from Mr. Sweeney. Mr. Sweeney turns around, buys from Mr. Davis, who buys from Ms. Nikolova, and that would be 4, and then we'd allow for the 0.3.
Okay.
So that would be the idea. Now, let me point out, in reality, GDP does not really measure the totality of spending. GDP measures some important categories of spending. It's the sum of all private consumer spending for newly produced goods and services, all spending that people make not for purposes of further sale. Anytime you buy something, not for the purpose of selling it. Like we buy food in the supermarket. We're normally not buying it to resell it. A little small diner possibly might. That would not be counted in the consumer spending that shows up in GDP.
And consumer.
It's final spending. A rough substitute for GDP is the idea of final spending. That's the spending that is not for the sake of further sales. And the largest component of that is private consumer spending. The next main component is government spending. The government is spending almost entirely not for the sake of making subsequent sales. So the main items in GDP are private and government consumption. The other significant item is gross investment. And the gross investment consists of plant and equipment spending, spending for new plant and equipment by the various private firms, and the net change in business inventories. These are the essential components of GDP. Private and public consumption spending, it's government spending on goods and services, and business spending for plant and equipment, and the net change in business inventories. And then there's yet a fourth significant component, which is net exports, which is, for many years now, a negative number to the extent that we import more than we export. So GDP is the sum of private and government consumption, new plant and equipment spending, plus net change in business inventories, plus net exports, positive or negative.
Those are all separate?
Those are components, all of which, when added together, equal GDP. You can get a breakdown of GDP many different ways, from the Department of Commerce, the BEA, I think is the name of the agency.
How do they get the net change in business inventories?
How do they get the net change in business inventories? Well, I would guess they go through a lot of business balance sheets at different, at one-year intervals. I don't know the extent to which it's an estimate. I'm sure a large part of it is an estimated figure, but I would guess that they have some sample of business firms in a benchmark year, and then they're seeing what the change is. Maybe they have more detailed reporting. I'm sure you can get an explanation of how every line in the GDP is calculated. It's in some publication of the Department of Commerce. There's another question out there somewhere. Oh, no one told me. It is. Oh, I'm so sorry. I've really run past the break time. Please, in the future, let me know, okay? I apologize. So, we'll see you. Come back in 25 minutes. I hope the refreshment stand is open.